The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to the Ascent, brought to you by Crestmont Private Wealth. My name is Sam McGee, and I'm the CEO and owner of Crestmont Private Wealth with offices in Boerne at 604 South Main and Houston, One River Way. Some of the statements I'll be making today are forward-looking, and they are opinions of mine, and there are risks with investing. Past performance does not equal future results. Investments may lose value, not FDIC guaranteed. Consult your advisor for your own investment advice. Today, our topic is about separating the economy from the market. Now, they are correlated. They are absolutely correlated. So there is a correlation between what happens in the economy and what happens in equity markets. But today, we're going to debunk a little bit of the myth, or the concept, in my opinion, myth, that there is a direct and immediate correlation between economy and market, and kind of separate the two. So let's first off talk about where we are. And this is recorded as of the 30th of October. So it's going to be a tiny bit stale, but we're talking about long term here. So if we go all the way back over 20 years, we've had three recessions. Actually, if you go back 25 years, we've had three recessions. We had the dot-com era, we had the financial crisis, and then we had the pandemic. I'm looking at here in front of me data from FactSet that we use at Crestmont, the U.S. federal funds target rate, which is essentially the interbank lending rate, or what you see on the news relating to interest rates, right? We're not talking about mortgage rates. We're not talking about your car loan rate. We're not talking about what your business loan rate is. We're talking about the U.S. federal funds rate that the Fed sets. If we look at those three recessions over the last 24 odd years, there is a pretty steep decline in interest rates precipitated by the three previous recessions. That does not mean that there is a direct correlation between lowering rates and an impending recession. It doesn't always happen that way. But what we learn from this is the economy and interest rates are regulated both at the same time by the Fed. The Fed is trying to regulate inflation, and they're trying to regulate either the heating up or cooling off of the economy at the same time. So imagine it's kind of like, you parents out there thinking about Ubering your kids over to gymnastics and football at the same time, and they both start at 8 o'clock. It's kind of a tough assignment, but the reality is that's what the Fed does. The Fed is looking at interest rates in relation to inflation, deflation, and on the other end, the economy, whether it's to stimulate it or slow it down. So it's a tough assignment, all right? So where we are today, Fed funds rate, as of this recording, is at 5%. Now, if we take a look at what's happened over the course of, say, the last 5 years, this is where we're going to separate the economy from the market and talk about what I mean by that. And this is meant to be educational. This is not meant to push any kind of agenda here. This is for the listeners out there that read the newspaper about the economy and they think that it is an automatic given that the market is going to react to it. Now, let's first start with what the economy is. The economy is really a trailing data point, really. It's looking back in history or today. It's not looking at what's happening going forward. It's looking at what's already happened. So it's looking in the rearview mirror. So for those of you that are driving, it is your current and it is your rear view mirror. That is the economy. That is what has been happening as reported by the government, that as reported by different polls and different sentiments and different indicators. It's what's already happened or is happening now. And the economy, people worry about what is it going to be like in the future. And they correlate the future economy directly to what the market could do or not do. Now let's break that down. Using that analogy of the economy being in the rearview mirror or today, or worrying about what's down the road, I want you to take yourself into a photo lab as an analogy. Those of you that were Generation X and did photo lab in high school or college, and you went and developed a photo, and you took it through all the little liquids, and you can't wait to see it, and there it is. Okay, that's a snapshot. That right there is an economic data point, a point in time. I want you to think about the market, the stock market, as a series of future photographs. A series of future photographs that have yet to happen, meaning it is out in the future. It is what the investor or the market or market participants think is going to happen. They think that there is going to be positive growth, or they think there is going to be positive earnings. And that is what really drives markets. Now, in the short run, the economy absolutely, when you see something happen in the market in terms of a bad number. So let's just go to something that's a data point. It does react. So let's take a look at the next set of data points. U.S. change in non-farm employment and unemployment rate. So if we go back over that same 24-year period and we have those three recessions, in those recessions, the unemployment rate goes up, obviously. People are laid off, businesses are contracting, and unemployment rate goes up. And in all three of those recessions, post-recession, you do see a trend towards lowering unemployment rate, meaning people are returning to work. That goes back to the dot-com era, that goes back to the financial crisis, that goes back to the pandemic. Where we are today, if we take a look at October 29th and we take a look at where unemployment claims are, they're actually at a pretty fair level historically, and the unemployment rate sits at 4.1%. That's the civilian unemployment rate, 4.1%. Historically, pretty low. So why are we talking about the unemployment rate, and why are we talking about an economic indicator as it relates to the market? Well, we want to separate that from what the stock market or the bond market or other equity markets are doing, because that data comes out after the fact. You're looking in the rearview mirror, okay? So when you're reading about the unemployment rate, that's getting funneled up to an aggregator, and then it gets published. And after it gets published, you know the rate, and the market will react. So typically, the mistake that a lot of investors make is that they correlate either a good number or a bad number in the unemployment as suddenly a reason to or not to invest. And it's the same thing with other employment data, U.S. retail sales, the ISM report on business, the current account for the U.S. as a percent of GDP, U.S. real GDP growth rate. If I put you to sleep, well, that's because this is a lot of data. There's a lot of things to follow. And markets are going to be very efficient, I believe. I do believe in efficient, semi-strong efficient markets, that the market will react in the short run to economic data, but really the market is going to be a reflection of what can happen and what is more likely to happen in the future in terms of profitability, growth, economic expansion, et cetera, et cetera. On the topic of separating the two and using the analogy of the photograph and the film, I really want this to stick with you. If you're listening to this and you're following every little data point that happens in the economy, I want you to take 10 giant steps back and think about those economic data points as being little pieces in the road that you're traveling on, okay? You're driving your car and you're hitting little bumps, and you're maybe hitting a speed bump, a recession, and you're moving that car down the road, but you're making progress. You're moving forward. I consider the car to be capitalism. I consider the car in motion to be the desire for businesses, the desire for personal growth, for wage increases, for prosperity, for changes in quality of life. I consider that moving car, that momentum, to be something that is a part of the U.S. DNA, okay? That is what's happening. That car is moving down the street, and we're going to hit bumps. But does that mean that you stop the car and you get out and you abandon the car? No, I don't believe so. That is the mindset of an investor. The mindset of an investor is that you're going to go through lots of economic periods, lots of them. If you've been around long enough, you know about the RTC back in the 1980s in Texas, where there were banks foreclosing on properties. You remember negative oil during the pandemic. You remember the countries that were about to default after the financial crisis. You remember the downgrade of the U.S. debt ratings. If you're really old, you remember the Cuban Missile Crisis. You remember different people in office. You remember different policies, different tax regimes. Are the cars still moving? Is the market still progressing? It is. And I think that's the mindset that I hope our listeners can take in and realize, is that the economy is not the market. I hope this has been useful to you. We really believe in financial literacy and education, and I absolutely love coming on here and talking about things that empower people. So I really hope that those of you that are listening, whether you're on the trailhead, the ascent, or the summit, meaning you're younger, you're middle-aged, or you're older, that this has landed with you, that this is something that you can relate to. And if it is, and you have wealth management needs, and you're either a high earner or you have a larger portfolio that needs some attention, give us a call or look us up on the web, www.crestmontpw.com. We are at 604 South Main Street in Boerne and One Riverway in Houston. We'd love to talk with you about this and get your take on it. You can also email us at info@crestmontpw.com. I hope you enjoy this show. We love getting feedback. Please let us know, and if you've got a topic you'd like to hear about in the future, we'd also like to know that too. Have a great weekend, and God bless.